Hello, and welcome to Virtual Investor Conferences. My name is Matt Lateplo, and on behalf of OTC Markets, we're very pleased you have joined us for our next live presentation from Ecora Resources PLC. Before I introduce our speaker, a few points to note. Please submit your questions in the question box to the left of the slides. If you are interested in scheduling a meeting with Ecora, please click on the Schedule Meetings tab found in the platform navigation bar. You'll be able to view the company's availability and submit a meeting request. On a final note, all today's presentations will be recorded and available for 24/7 replay. At this point, I'm very pleased to welcome Kevin Flynn, Chief Financial Officer of Ecora Resources PLC, which trades on the OTCQX Best Market under the symbol ECRAF, and on the LSE and the TSX under the symbol ECOR. Welcome, Kevin.
Hi, thanks, Matt, and hello, everyone, and thank you for your time and your interest in Ecora Resources. Just skip through to our disclaimer slide. First of all, please feel free to study that at your leisure. So Ecora Resources, we are a leading future-face commodities royalty company. So kind of what does that mean, I guess? First of all, we're offering exposure and access towards more of the base metals rather than the precious metals side, which obviously this conference is covering both. So we're more focused on the battery metals, what we call future-facing commodities. I suppose, second of all, we're not here to pitch a project or an operation or a specific commodity. As a royalty and streaming company, we offer diversification and a broad kind of basket of commodities and therefore projects with which to gain exposure to. And there are some key points of difference between royalty companies and the underlying operating and producing companies. Not least that we're not single asset. We offer the diversification both in terms of commodity, jurisdiction, and project as well. But this diversification is at price level usually, rather than margin level, which you would associate more with operating businesses. And as such, we're much less exposed to the underlying capital and operational cost risk associated with mining projects. So that's kind of a brief overview of Ecora. We have a world-class royalty portfolio already, which has got several cornerstone assets already within our portfolio. We've got a very strong growth profile in our business currently from organic sources, and we'll touch on this later as we go through the slides. What differentiates us in our sector specifically, and this covers both the precious and non-precious metal side of the royalty and streaming sector, is we've got a leading dividend yield. Currently, I think when I checked the screen before coming online today, our yield is currently about 5.75%, and that's comfortably sector leading in the space, especially when you consider that the royalty and streaming model, by its very nature, provides a less risky way of gaining exposure to commodities in general. We've got a proven track record. I've been with the business now as CFO for about 11 years. Mark, our Chief Executive, has been with the business 9 years. So between us, we've got 20 years of working very closely in this space, acquiring assets, proving that there is a business model for non-precious metal royalty and streams. And we can touch on that in a couple of slides' time as well. Not surprisingly, with a firm focus on future-facing commodities and providing exposure to commodities like copper, nickel, etc., sustainability is kind of very much at the forefront of our investment criteria. Our ESG profile has improved a lot over the last couple of years. Again, I'll touch on this shortly. And as has already been said, we're listed on the LSE, the TSX, and we trade on the OTCQX as well. The tickers, I think, are on the screen. Okay, so commodity selection. I think hopefully the nature of this conference and the people listening in right now will firmly be believers in the energy transition. And this is very much the basket of commodities and the exposure that Ecora has built to offer investors in this space. If we look at the right-hand side of the box, these are the commodities we really focus on and we're looking to gain exposure to in terms of building out our royalty and stream portfolio. The ones outlined in the boxes, copper, nickel, cobalt, and vanadium, are ones that we currently have in the portfolio. The other commodities are the ones that we don't presently have, but the ones we're currently very interested in increasing our presence with. And that will continue to be the strategic focus of the business going forward. We run kind of two different strategies in terms of how we think about future-facing commodities. One is clearly those which fit into battery chemistry, EVs, etc. That's on the top of the page. But also on the bottom, there is room in our portfolio for those commodities which are much purer and can contribute to a less energy-intensive way of producing end products. And a good example of that is we have exposure to the Labrador Iron Ore project, which produces some of the highest quality pellet premiums globally. And that obviously facilitates the production of steel in a much more energy efficient way. So the energy transition, well, this slide really shows you why we at Ecora firmly believe that the trend here is very positive and proves that there is going to be a genuine need for the commodities that we've currently got exposure to and those which we are looking to gain exposure to. I think this graphic shows you the Tesla battery plant in Texas, and the percentages that are shown in each of the commodities in the different colors represents the global supply of each of those commodities currently. Now, if you look at that being a 140 gigawatt factory, and the fact that it's estimated that both in Europe and North America, there's going to be over 1,000 gigawatt additional plants to come, that's a 7x increase in what we currently have. This really should fundamentally drive the necessity for these commodities and future demand that we expect to see coming in the remainder of the decade. And if you want to put dollars and numbers towards that, on the right-hand side of the page, to achieve net zero, and these aren't our numbers that you can see in the footnote where these have come from, for copper, for instance, that would bring us to current $57 billion sector to $319 billion. Nickel goes from 8 to 68, and so on and so on. And that's really why we believe building out a royalty and streaming portfolio that's closely aligned to commodities such as copper, nickel, cobalt, lithium, etc., is a very appealing investment prospect right now in terms of providing exposure to the energy transition in general, whether that is just in the construction of electric vehicles, whether it's to do with battery storage, mass battery storage, etc. These commodities will be closely aligned to that as we go through the next decade and beyond. So looking at it more from a micro perspective and Ecora, if we go back to when I joined the business in 2012, Ecora basically had one large coking coal royalty in the Kestrel mine in Australia. Now, this mine at the time was known to have a relatively short mine life. And what we did over the next 8 years or so was to take those cash flows and recycle them in to future-facing commodity royalty and stream exposure. But our first challenge, given that Kestrel was relatively short-term in its nature, was to provide a meaningful path towards replacing that through-cycle revenue that royalty was creating, such that over the longer term, so certainly out to 2030 and beyond, Ecora as a business would have a sustainable income profile, take a view on commodities, but anywhere between $40 to $60 million from this core group of royalty portfolios that we recycled our Kestrel cash flows into. So that was very much objective number one. And to some extent, that was to prove that there was a business model and a business case for royalty and streams outside what had hitherto been very much a sector focused on precious metals So I think that's objective one kind of complete, and that was completed with our Voisey's Bay cobalt stream acquisition in March 2021. Objective number two was really to, now that we had stabilized the revenue portfolio of the business going out to the next decade, was to provide some meaningful growth opportunities and optionalities into the business, whereby based on a stable platform of income producing assets, there was a meaningful path towards further growth, both in terms of earnings per share accretion and increase, and therefore by default through dividend cover and dividend growth potential. Now, this objective we believe we've recently fulfilled, and that was through the South32 acquisition, whereby we acquired the two main assets in that portfolio, which was the West Musgrave operation, which we'll come to shortly, of which we were very pleased to see today BHP completed their takeover of Oz Minerals. But also included in that portfolio was the Santo Domingo project in Chile, which is owned and will be operated by Capstone Copper. Again, we'll come to those in a little more detail shortly, but those in addition to the other assets in our portfolio and optionality in terms of Piauí, Inco and others, provides us with a very sure profile of growth, both in terms of income, but also NAV accretion as well as these projects come more towards production. Having achieved objective one and objective two, objective number three is very much to become a bigger business and a bigger organization, providing greater liquidity, which will then enable us to continue on our journey of adding further kind of growth and diversification into the business, very much along the lines of the commodities which I showed you on the other slide, which are key kind of targets of ours, but also to keep diversifying the business in terms of ultimately, I suppose, becoming a more low volatility beta play in the sector rather than providing single asset exposure to one operation. So we're looking to be a much de-risked way of playing the sector in this space. So our portfolio. This slide here shows you our portfolio of producing royalties, so those ones that are already in production and those which generate meaningful cash flow for us. And as kind of, I'm sure a lot of this audience will be aware, some of these projects will be very familiar. Our cornerstone asset in our business right now in terms of producing, income producing, is Voisey's Bay. This is a cobalt stream that we own over the Vale nickel mine in Canada, which is currently transitioning from open pit to underground, with the ramp up expected to meaningfully accelerate in 2024 onwards. But nonetheless, we've been incredibly pleased with this investment, which we acquired in March 2021. And the average cobalt price we've achieved to date has been close to $30 a pound, well ahead of our investment thesis. Mantos Blanco is a copper mine in Chile, operated by Capstone Copper, and we'll see Capstone Copper on the next slide with the Santo Domingo project I mentioned earlier. This is really Capstone creating a copper district in Chile, but with the expertise and the kind of operational experience of building copper projects in the locality, which has resulted in a very successful investment by us into this Mantos Blancos project, which is currently benefiting from operational upside through a debottlenecking plant in which our actual royalty was part of the financing project for. IOC, as I mentioned, is the exposure to the Labrador Iron Ore Royalty Company, the IOC project operated by Rio Tinto, producing some of the highest quality pellets in the world. We also have exposure to Largo Resources vanadium project in Brazil, again, one of the lowest cost vanadium operations globally. And this has been another very successful royalty acquisition that we made, I think, in 2014, with very good upside, and we've seen that come through in terms of reserve expansion. We also have some exposure to the Cigar Lake uranium operation in Canada through the McLean Lake Mill. This isn't conventional kind of price exposure. It's through a tolling operation, but we get exposure to volume upside from Cigar Lake as and when it comes through. And the last one just to touch on here, Kestrel is obviously our legacy cornerstone asset, which produced record royalty contribution for us last year of $107 million. We know this royalty is not going to repeat that level of contribution in the years ahead. There's a planned kind of phasing out of our private royalty area currently underway there. We expect to see about 40 to 50% of the volumes we achieved last year this year, and then it's going to gradually step out over the following 2 years. But nonetheless, it's been a fantastic income generator for the business, which has enabled us to fundamentally transact on the $400 million of royalty and streams we've done in the last 2 years. Our growth pipeline currently in the business is arguably more exciting. And I think for the first time since I've been with the business since 2011, 2023 is really shaping up to be a year of huge organic kind of news flow for us in terms of bringing some of these projects towards production. The key one at the moment is obviously West Musgrave. This was an Oz Minerals project, which is currently in construction in Australia. BHP have obviously acquired Oz Minerals recently, and we fully would expect BHP to continue the work that's currently being undertaken locally in terms of the construction, and we're very optimistic. And obviously, the value of this royalty, less than 12 months after acquiring it, of having BHP now as the operator and custodian of this project, can only enhance the value of this royalty for us, and we're very optimistic about this in the short term. The Santo Domingo project is a very important project for us. We think there's been a huge de-risking event here when Capstone Copper acquired Mantos last year. Mantos are currently undertaking a development project, bringing a project into construction called Manta Verde, and Santo Domingo is probably only about 20 kilometers away as the crow flies from this project. So there's an enormous synergy here, which is really going to enhance the economics of the Santo Domingo project, and Capstone themselves are bringing out synergy studies on this later on in the year. The Piauí nickel and cobalt project has really got the potential to be a game changer for Ecora. This is a project that we acquired an option on in 2018 for $2 million to invest a further $70 million once the project is de-risked and fully funded. We're just back from site actually on this one, and we're very encouraged by the progress that's taking place here. And this is obviously a royalty which we would love to execute on once all the conditions are met. And has the potential to be a real cornerstone asset in our portfolio going forward. Just conscious of time, those are the main growth ones we have, but there are plenty others in there as well, not just the ones listed on this page. So looking at how this kind of translates to dollars, the darker blue bar is our future-facing commodities portfolio currently. So basically our current producing portfolio, less excluding Kestrel and some other small ones. We expect to see this ramp up as indeed Kestrel, the lighter blue bar, kind of depletes and moves outside of our private royalty area. But importantly, when we look at the growth assets that are currently in construction, and those which are in development, there really is a path for this business now to generate more than $100 million of sustainable revenue in the business in the medium term. And that really is the piece that Ecora has been missing in its kind of portfolio over the last number of years prior to the South 32 transaction, when we felt we were very much still trying to replace Kestrel through cycle revenue. And clearly the returns on assets where you do take some construction and or development risk the returns are much higher than acquiring income-producing assets, which tend to be much more expensive. So we're very excited about this growth profile, both in terms of what it does to our income profile in the medium term, but also the NAV accretion that it's going to drive for our business too. I think I've mentioned most of the catalysts, but as I said, 2023 is looking to be a very busy year for the portfolio, for our growth portfolio, with Capstone Copper releasing integration studies and a phase 2 expansion potentially underway at Mantos Blanco. We expect the ilmenite plant at Largo to commence construction. Voisey's Bay is continuing, making very good progress in terms of its underground transition and the ramp-up profile that we expect to be delivered in 2024. Piauí is actively now constructing its pilot plant and looking to raise the finance for the large-scale project. And obviously, Oz Minerals is currently in construction, which, in terms of our investment thesis, is probably marginally ahead of where we thought we'd be, and really has the potential to drive short-term earnings growth as well. So there's a lot to come from our portfolio in 2023, and that's before we've done anything else in terms of acquiring additional bolt-on royalty and stream acquisitions. So how are we going to do that, I suppose? Looking at our capital allocation priorities, balance sheet strength is something that's very important to us. We've been relatively creative in terms of how we've financed the non-producing assets in our portfolio in a way which preserves balance sheet strength and also kind of minimizes dilution in the short term. At the end of Q1, we had only $35 million of net debt. We expect with capital commitments that that's going to increase over the course of the year. But with the 200 million line of credit, we've very good financing flexibility on our balance sheet to continue our growth story, which is the second pillar. We still think it's a very good time to be deploying capital. Unlike precious metals focused royalty and streaming businesses, we've got a mandate to invest across a much broader depth of commodity base, which means we're not investing in one or two commodities through cycle, which provides us with plenty of options to deploy capital in accretive and clever ways, and we continue to see good opportunities to do that. As I mentioned, we've got a sector-leading dividend. This is now 8.5 cents. I think we've rebased to 8.5 cents per annum. This we expect to be fully covered even in the years in which we now kind of are transitioning out of Kestrel. So there's about a year or two of a transition between Kestrel moving outside of our private royalty area in West Musgrave, coming fully on board. But our dividend is protected in that period. And above that, we always look at other forms of shareholder returns. One of the things which Mark and I are very closely aligned on is that whenever we consider investment opportunities, it really has to be with a per share focus in mind, both in terms of earnings and NAV. And that's something which we're quite proud of our track record to date in terms of building out this portfolio. I won't dwell on this slide too long because I've run over a bit, I think, but we made enormous strides in 2022 in terms of our sustainability disclosure. We're now an active participant of the UNGC, and our Sustainalytics rating increased enormously during the year as well, from severe of 44.7 to a low of 14.2. So we're very pleased with that performance. We're obviously we're on scope 1 and scope 2 emissions, we're net zero. We're obviously still undertaking a lot more work in terms of scope 3 analysis, and this is obviously a work in progress for us. But with ESG at the core of our business, this is something we take very seriously, and we're looking at ways which we can improve our disclosure and indeed our scores in the year ahead. And I think this is the final slide. So why invest, I suppose? Well, we've put this slide in, which kind of shows you comped against the non-precious metals universe. The green bars below is the precious metals universe. We tend to operate outside of precious metals purely because it's very difficult to compete with the precious guys in terms of cost of capital. In terms of market cap, we're just under $400 million currently, and that's at a 0.6p NAV. Given that most of our stock trades on the LSE, there's obviously some very London-centric issues currently impacting the UK markets. But as we would say, it presents a very good buying opportunity for those who see value and really believe in the energy transition in the way that we do, because we would expect naturally, as the coal leaves our portfolio and our portfolio becomes 100% future-facing commodities, there should be a natural path towards rating enhancement, notwithstanding anything else we do in terms of objective 3 of getting bigger and more liquid. Okay, now I'm very conscious of time, so I think it's over to Q&A next. I've dealt with the outlook, haven't I, in terms of what we look at doing and what our next step in objective 3 is. So let's go to some Q&A. So I've got a question here. What are the characteristics we look for in a portfolio company? Very briefly, I think there are a couple of fundamental things we look at. We look at very firm technical prospects. We've got a good in-house bench here who can really understand the technical merits of projects. But we look at management teams as well and track records, because these are ultimately going to be very important, because once invested, there's very little you can do to change the shape or destiny of the project that you've actually invested in. So these things become very important to us. Position on the cost curve, whilst not necessarily a company-specific thing, is something very important to us, certainly in times of inflation like this. It's very important that for us, an investment that we make can endure through cycle. What percentage of our portfolio is publicly traded companies? I don't know that off the top of my head, but I think the market cap of the listing producing counterparties is now over $200 billion. So in terms of our counterparty risk, we think we've got a pretty sector-leading bench of counterparties here. We've got a question here asking, are directors obliged to acquire shares with their own financial resources? There are certain guidelines here in the UK as to percentage of current salary that you have to obtain in shares. And whilst we may not be necessarily obliged to, Mark and I have certainly been purchasing on market with our own resources. Will Ecora consider repurchasing shares given the decline in the share price? Look, I think ultimately we are allocators of capital, and I think we always look for value. We think the shares are not fully reflecting the value, certainly the growth in our portfolio. So it's something we always look at as par for the course. Are we going to do it? Well, we'll see what other opportunities present themselves. Status of relationship with South32, very, very good relationship with South32. They're outside of their lockup period, either last week or very, very recently. They've given us no real indications as to what they are going to do with their holding. We've got a very good relationship with them, and they've chosen at this juncture not to put a director on our board. So we think that speaks volumes. Let's see if there's anything else here. I think that may be all the questions, which is right on time, I believe. So yeah, I guess from my perspective, thank you everybody once again for your time and your interest in Ecora. Hopefully that's been a useful intro to the company. And if you'd like anything more, I'm sure through OTCQX we can arrange follow-up.